A very good morning, friends. First of all, welcome you all to the revisionary sessions conducted by the Board of Studies, Institute of Chartered Accountants of India. I'm Kapileshwar Bhalla, Chartered Accountant by profession, and we have a good journey in terms of revising the important and, of course, the interesting topics for financial reporting paper. We're starting a journey today with the standard on revenue. There is Ind AS 115. There is revenue arising from contract with customer. Well, of course, the idea is to go with the implicit presumption that, of course, you know the concepts very well, and we want to do a lot of extensive practice in terms of getting more hold on the particular topic. So here and there, of course, if you feel that there is any need of elaborating a certain concept where you want a quick brush up in terms of any of the parameters, you can just let me know. We can do that as well. But of course, as I said, the implicit presumption is that you know the concept. So what I've done, I have made a selection of almost around 20 questions. I've called them as 20 super quick questions. And of course, if there is time, we'll do some more additional questions as well. The idea is that once we make a walkthrough of these questions, you will be able to make a walkthrough of the larger concepts of the standard as well. And we will be doing some bit technical questions as well. So that, once the questions are done, you should be standing, of course, more confident in terms of the standard. And it'll be giving you a complete walkthrough in terms of various, concepts which are there. Because what happens is when you do a little more structured learning, when you're doing your practice, then of course, once you go through the standard and do a couple of illustrations, your concept definitely gets strengthened, of course. So I think let's begin a journey. I am going to start with some very basic questions to begin with. But of course, as we're going to progress, we're going to take some more complicated questions with you as well. So as I said, anytime in between, if you feel that there is a need to, just give you a quick brush up in terms of any particular concept, we'll do that as well. So I think before I take you to the journey on the questions on 115, just a quick brief in terms of what question I'm going to start with. Well, I think just to recall, when you look at Ind AS 115, revenue arising from contract with customers, I think before the 5-step model hits you, the first thing which should come to the mind is the scope of the standard. So we're looking at, typically questions based on what I call the barter deal. That there's been an exchange of goods and services, which means one entity is not making a payment of consideration to the other, but it's a barter deal. So we need to be clear on certain areas as well, that if there is a barter deal, then in that particular case, are we within the scope of the standard or not? I think I'm not reminding you what are the provisions of the standard in terms of the barter deal. But I think let me still ask you, do you remember what are the provisions as far as the barter deal is concerned? When two entities enter into transactions, then what kind of provisions are given in the scope of the standard? Do you remember them? So in the meantime, as you send me the answers, let me share the assignment to you. Let me know if the questions are visible to you. Right, I hope the visibility is good to watch. Right, I hope friends, you're able to see the board. The questions are clearly visible. Good to go, I guess. Okay, I didn't get much message on that. I presume, yes, you can watch it carefully. Okay, so I think let's begin with some warm-up exercise. And as I said, we're going to start with some very basic questions, understanding the scope of the standard. Nobody even told me that, are you clear with the concept, the scope of the standard? I guess unless mentioned otherwise, I presume it to be a yes. Okay, let's begin. Okay, so we are given, it says A and B are both engaged in manufacturing of homogeneous bottle. That is indicative that they are into the same line of business. As I am solving these questions, let me also tell you, sometimes we do falter in terms of reading the question with the correct intensity. So I always tell people, that you must spend a good time reading and analyzing the question. Because half the battle gets fought only at that particular stage. As you read the question, the wordings will give you a lot of inputs in terms of how you're going to answer that question. So it says A and B both are engaged in manufacturing of homogeneous bottle, which is indicative that they are into the same line of business. I think I just like to make a mention out here. So this is indicating that they are into same line of business. Then it says A operates in northern, eastern, and central parts of India. And then it says B operates in western and southern part of India. So they are operating in different parts of the country. So both the entities are operating in different parts of India. Then he says A fulfills the demand of the customers based on western and southern India by using the bottles manufactured by B. And similarly, B also fulfills the demands of the customer based on northern, eastern, and central part of India by delivering the bottles manufactured by A. So A is trying to fulfill the demand with the help of B, and B is trying to fulfill the demand with the help of A. Now the question is this within the scope of this standard? The question says, how would A and B recognize revenue? The question is this transaction within the purview of Ind AS 115? So let's get your answers on that. So they are into the same line of business, and A is fulfilling the demand of its customers by taking the help of B, and B is taking the help of A. So is this transaction within the purview of Ind AS 115? Are we going to recognize revenue in the books of A as well as the books of B? And that's exactly right. No, it is not. Because in this particular case, the reason we can give is that there is no commercial substance. There is no commercial substance. Though this is a pretty simple and a straightforward question, and I think I'm not going to spend too much time on these kind of questions, but I think I'll just give you a basic insight that, when you write your answers in the exam, what is important is, I always tell people that you should frame your answers in, I would say, 3 stages. The first is that you should tell the examiner what the given standard states. Like, for example, in this particular case, you need to tell the examiner about the provisions which are contained in the standard with regard to a barter deal. You need to bring out the highlight that if there is a barter transaction, but the entities are in the same line of business, 1, and there is no commercial substance, 2. You need to bring these 2 points very carefully, that if they are into the same line of business, that's 1, and there is no commercial substance, there is 2. You need to make a mention that Ind AS 115 says it is outside the scope of the standard. Then in the second paragraph, you should correlate the facts of the case, and you need to explain it with the provisions of Ind AS 115, that based on the facts of the case and what Ind AS 115 tells you, that what is the conclusion. Make your analysis of the facts. So in this case, you can say that they are into the same line of business, meeting the criteria 1. There is no commercial substance, meeting the criteria 2. And then finally, in the third para, you could just give a conclusion line that considering the facts of the case and the provisions which are given in Ind AS 115, this transaction is outside the purview, outside the scope of Ind AS 115, and therefore nobody lands up recognizing revenue. I hope, then, friends, that helps. I don't think so that I need to give you a detailed documentation regarding the answer of this. The key criteria is very clearly pinpointed. Okay, let's go to the next one. Now, continuing with a few more questions on the scope of the standard. So I'm just making a mention out here as well. that what we are discussing is a warm-up exercise discussing the scope of the standard. Let's go further. It says entity A and B are both engaged in extraction and supply of natural gas. And I think the moment you read this particular part again, what flashes to your mind is they're again engaged in the same line of business. So I think I'll just make a mention that in this case, again, we can say they are in the same line of business. After you've done these questions on the scope, we'll just quickly make some quick mind maps as well as we keep progressing further. It says they're engaged in the extraction and supply of natural gas to different parts of India. A is located in the western India, while B is located in southern India. Then he says A contracts to supply natural gas to a large corporate customer XL who is located in southeastern region of India and who is engaged in the supply of natural gas to homes. B, on the other hand, contracts to supply natural gas to YS, which is located closer to A Limited. Consequently, A purchases from B, I'll look at the word purchases from B to supply the natural gas to YS, and B purchases from A to supply the natural gas to XL. So they are basically making a purchase of gas to supply to their customer. Now the question to be seen is that are they taking help from each other? Is there a concept of a commercial substance, or is the commercial substance lacking? That would be the deciding factor. Then he says the price of the natural gas for this transaction is based on the actual delivery date of the gas by the either party. Yes. Yeah. Okay. Okay. So that's what I asked. Okay. Okay. I just asked actually in the initial, nobody responded back on that. Okay. Let me then I think erase this part, I guess. Okay. Is visibility good now? Yeah, my request, friends, I was asking earlier, I think the message came quite late. So please do respond, if the visibility is not good, I will adjust the things. So please give me the inputs on the chat box if you can. Okay, so let me just come back on the question number 2. So in terms of this, we just read that both the entities are in the same line of business. That's one. And we're also read very clearly that A is making a purchase from B. And we're also given in this case that B is also making a purchase from A. I was just highlighting the word A purchases from B and B purchases from A. Then the further facts which are entered is the price of the natural gas for this transaction is based on the actual delivery date of the gas. Further, the parties would also do monthly calculations of supply and the receipt
Sir,
of gas.
sorry, excuse
And
me, sir.
yeah,
Excuse me. Sir,
yes, ma'am.
your screen is still not visible. Your fonts are very blurry. The
Okay,
screen is blurry. I don't know.
just a
Matlab,
second.
you please ask other students also.
I'll just, I think, ma'am,
It's,
just
it's
a minute.
blurry. I maybe some network issue is at my end. It may be like that. I'm just confirming with other students also. If it is okay with all students, then it's okay. Maybe network issue at my end. Okay,
Yeah, ma'am,
Saminathan
it's
is saying it is not clear. No, it is not clear. So he's also saying it is not clear.
I just got a message, ma'am. It's visible. Can you
Fonts
please
are,
let
sir,
me?
we are not able to read it. It is blurry.
Okay. Let me
I
just,
think
ma'am, switch on and switch off the camera.
nice. Sir, your camera focus maybe is on you, na? You are coming clear, but your background screen is coming black. But background वाला कुछ लगा रखा है, sir, आपने शायद. बिकॉज बैकग्राउंड आपका पूरा ब्लर है, फॉन्ट रीड नहीं कर सकते सर हम, सिर्फ 115 जैसे रीड हो रहा है, इंडियंस वी कैन मेक आउट, दैट्स ऑल।
ओके,
वो आपका कैमरा फोकस होता है ना सर,
राइट राइट मैम।
वो वाला है शायद कुछ।
I'll further increase it, I guess, ma'am.
That is not because of increasing it, it is because the fonts are not visible.
So maybe I think, ma'am, I'll share it on the. Okay, I
This
think, ma'am, I'll share the
who is
question on the
saying this,
screen.
a
I think the
student
laptop.
or Manishi, you are saying this? Because see, Samyanathan is also saying it is not visible, na? So let's see it from whose part it is issue. Medhaj, Khalid, Hasnat, I would like you also to just respond. Is it okay to you all? Screen is visible. Are you able to read it? Meenal, Shalendra.
Okay, no worry, ma'am. I'll just share it on the screen, I think, ma'am.
See, they are also saying font is not visible. Poor print quality. High, all not bad. It's okay at my end. Okay. Shalendra is saying it's okay at his end. Better see YouTube as well. Better in YouTube, you won't be able to then chat or queries, na? Then you have to use two sets.
I can
See,
share it on
they
the
are also
screen,
saying the
ma'am.
words are a bit blurry. So see, students are saying that words are a bit blurry. I think it's in a camera
Yeah,
setting,
I'll share
sir.
it on the screen. I'll share the question, ma'am, on the screen out through the laptop.
Okay, okay, sir. Now it is visible,
Yeah,
sir.
please let me know if you can see the screen.
It is now visible. Now it is perfectly fine. It is properly zoom also,
Right,
and it is visible. Okay, sir.
perfect.
You can continue, sir. No?
Yeah, so I'll just, I think, read out the question from the screen out here. Okay, let me just read the question now to you. So it says entity A and B. So I think I'll just have to sit down to just underline the question as well. So then I think we'll solve it on the board. Okay, so I am given the inputs. It says entity A as well as entity B are both engaged in extraction and supply of natural gas to different parts of the country. So when we say that they're both engaged in extraction of supply of natural gas, this is indicative that they are into the same line of business. Then he says A is located in Western India and B is located in Southern India. So that means they are located in different parts of the country. And then it says A contracts to supply natural gas to a large customer XL who's located in southern east region of India, who's also engaged in supply of natural gas to homes. Then he says B on the other hand. Then he says B on the other hand, it says is supplying natural gas to YS located closer to A. Now the key word is A purchases from B. And then it says B also is purchasing from A. So A is making a purchase from B and B is also making a purchase from A. Then he says the price of the natural gas for this transaction is based on the actual delivery date of the gas by either party. Further, the parties would do a monthly calculations of the supply and the receipt of gas, and they do a net settlement based on the prices calculated above. In the said industry, the prices varies based on a different product category and also varies on the point of sale. Now, I think the only thing which needs to be seen is, of course, they are both engaged in the same line of business. But I think what we need to see in this particular case is that is there a commercial substance or not? Now you can see that A makes a purchase from B, B makes a purchase from A, and in this particular case, we can say that they're sitting down at the end of each month and they're doing a net settlement of all the transactions which has happened. So the main question is that is there a commercial substance or not? So let me, I think, put that question back to you. So what do you say? Is this within the scope of the standard or not? And that's rightly said, absolutely. So we can say, yes, this is undoubtedly within the scope of the standard, because now we can see the first parameter is met, that they are in the same kind of business. But I think we can definitely say that there is a commercial substance. I'm putting it as CS. And the moment you say that there is a commercial substance, it is definitely within the purview of Ind AS 115. So as I said, when you're going to, create an answer, you need to, in this particular case, again, divide your answer in a simple 3 paras. The first is you again explain what is the, provisions of Ind AS 115 with reference to this particular barter deal. The second, you relate the facts of the case to the provisions of the standard. And finally, you come up with the conclusion that yes, in this particular case, it is supposed to be within the scope of the standard. Okay, now last question on this area on the scope. Then I think we can go to the next phase. Okay, now next one I am given. A is a telecommunication company entered into an agreement with B, which is engaged in the generation and supply of power. Now we can very clearly see that A is in a different line of business and B is in a different line of business. And as you notice that they are into different line of business, your mind should start working whether it is in the purview of this particular standard or not. Then he says the agreement provides A that A would provide a total of 1 lakh minutes of talk time to the employees of B in exchange of getting a power equivalent to 20,000 units. A normally charges 50 paisa per minute and B charges 2.5 per unit. Now, the requirement of the question itself is quite indicative whether it is within the scope of the standard or not. When it says, how would the revenue be measured? I think you can make your conclusions very easily. So let me, I think, still ask you the very obvious question that is this within the scope of the standard or not? And I think I rightly got the answers. Yes, of course, it is within the scope of the standard. The reason is that both the entities are into different line of business, and the moment they are into different line of business, we easily draw a conclusion as well that there is undoubtedly a commercial substance as well. So I guess we can definitely make a conclusion that in this particular case, when they are into different line of business, it is of course always implied that there is a commercial substance. And when the question is asking us how much revenue should be recognized, so that also makes it very clear that if it says what revenue will be recognized, unless the transaction is within the purview of the standard, naturally in this particular case, the question will not ask you to measure the revenue as well. But I think that's a very subtle hint, but I think we should definitely pick that hint up as well. Now, there are 2 aspects, once you say that the transaction is within the purview of the standard, you also need to take a call and decide that is this particular, if it is within the transaction, how are you going to measure the revenue as well? Now, I think let's see how much revenue would A recognize and how much revenue would B recognize. Now, since it's a barter deal, A is a telecommunication company and is providing 1 lakh minutes of talk time, and each minute is worth 50 paisa. And in return, what he's getting from B Limited is 20,000 units of electricity, which is chargeable at the rate of 2.5. So quick question to you. When A is going to recognize a revenue, is he going to consider a revenue which is 1 lakh into 0.5? Or is he going to recognize a revenue that is 20,000 into 2.5? Very carefully. So is the revenue equal to what you're giving or is the revenue equal to what you're receiving? So is A going to recognize the revenue equal to 1 lakh into 0.5? Or is he going to recognize 20,000 into 2.5? By the way, both of them comes equal to the same figure. Okay, and I am given the consideration paid is 1 lakh into 0.5. Oh, I'm afraid in this particular case, when A is going to recognize a revenue, we need to see what he gets. In this particular case, we can say that A is getting a total of 20,000 units of electricity, and each unit of electricity is worth 2.5. So he's going to recognize a revenue to the extent of 50,000. So what you get becomes the revenue for A. Similarly, what does B get? B is going to get a total of 1 lakh, you can say, minutes of talk time, and each minute of talk time is worth 50 paisa, and that comes to 50,000. So as it is, we can just keep in mind that when you look in terms of revenue, it is what is the consideration received becomes a revenue. So not what you give, but what you acquire. That's absolutely correct. So I think these three questions have given us some very basic insight in terms of things. So let me just correlate the three inputs which I gave you. I'm just going to stop sharing the screen for the time being, and we'll come back to it. So I guess, what is coming at the back of the mind is that, if you just connect the dots at this particular stage, we can say, if I just summarize the provisions of the scope of the standard, your mind should start working into, are they into same line of business or are they into different line of business? Now, when you say they are into the same line of business, your mind should start working that in this case, is there a commercial substance or is there no commercial substance? So we can say there are three permutations, combinations. If you are into same line of business and there is no commercial substance, in that case, no revenue recognition is taken. The second is if they're into same line of business and there is a commercial substance, then revenue recognition is taken. And the third combination is if they're into different line of business, I don't need to make any assessments in terms of commercial substance. It is always implied if they're into different line of business, there would be a commercial substance. So I think the conclusion should be very clear in your mind. Same line of business with a commercial substance. Do we take a revenue? Yes. Sorry, same line of business with a commercial substance? Yes. Same line of business with no commercial substance? No. And different line of business? Outrightly, yes. I guess, friends, we should be absolutely clear with the concept of scope of the standard. Right? Ready to go to the next phase now? Now, before I take you to the next phase, let's just connect a few things in the mind as we progress further. Now, you already know that when you look at Ind AS 115, this standard, gives you a 5-step model in terms of revenue recognition. So as a part of the exercise of, revising the standard, I've picked up questions on each step, but there are a few questions which are, of course, very comprehensive in nature, which we are going to solve them fully. But I think let's just, first quickly run a mind on the 5-step model. The step number 1 is to identify that the contract is supposed to be a valid contract. I'm just running the things at the back of my mind. Now, when you say that it is supposed to be a valid contract, your mind should start also working in terms of the fact that there are some 5 essential elements of being a valid contract. Now, I think this kind of area could be well tested in an MCQ as well. So I think you cannot, ignore the fact that step number 1 may not be a very crucial point, because when you get MCQs could also test you on these kind of areas that, they give you a certain set of conditions and you need to identify, that which one is perhaps not a, valid point or which is a valid point. So I'll just, remind you that there are 5 essential elements. I'm not reminding the elements as of now, but you know that there are 5 essential elements and even one of the element is missing, then in that particular case, it is not a valid contract. And if it is not a valid contract, you cannot go to the step number 2. Then in terms of the step number 2, the crucial point is identifying the performance obligation. And when you identify the performance obligations, you need to do an evaluation from the point of view of both the entity and the customer. And then the conclusion comes that what are the performance obligations? But just keeping in mind, performance obligations are not synonymous with the word promises. The contract may have multiple promises but may land up getting a single performance obligation. Then the third step, which I think is a very crucial step, where we're going to spend some good time as well doing some major questions with you. There will be some wonderful questions on the step number 3, which is the determination of transaction price. And the moment you think of a transaction price, what flashes to the mind is the concept of a variable consideration, the concept of a significant financing component, etc. Then the fourth step is the allocation of the transaction price to the various performance obligations, and per se, it is all done in the ratio of the standalone prices itself. And then finally, the step number 5 is on the timing factor on the revenue recognition, which is identifying, do we recognize a revenue at a given point in time? Or do we recognize a revenue as and when the work is being done? Now, when you consider the revenue on the basis as and when the work is done, you'll end up considering what is called a percentage completion method. And when you say no, that we're going to recognize a revenue only once a given performance obligation is met, then you apply a completed contract method. And of course, within this 5-step model, other things also comes into mind because there are a couple of special issues which are given in the Ind AS in the appendix of the standard as well. That was just to connect you to a few dots. Now what I'm going to do, I'm going to take you now to a question on the step number 1. I'm going to show you a case study, a small little question where you're going to identify, is that contract a valid contract or not? Let me come back on the screen and share the question to you. Okay, so I guess let's come back and let's share the inputs to you. I think I've already started getting the inputs in terms of what are the essential elements of a contract. That's great. Okay, so let me now share the screen back again to you, and we're just going to look at a case study to identify this part. Look at the question number 4. So I'm just going to read the facts of the question number 4, and we're going to see that is it a valid contract or not. It says X Limited provides IT support services to its customers from a distant location. The customers call up the support team of X, who understand the client's requirements over the phone, and they provide the necessary advice to the customer to resolve the issue. Now it says, before providing the advice, the support team will understand the client's problem and inform them about the price for the services to be provided. Once the problem is resolved, the customer will make the agreed payment. The customer will make the agreed payment, and it says that will be through an online banking mode. X considers that the collection is probable and the oral contract is enforceable as per the laws applicable to the jurisdiction. Now, in such a case, whether there is a valid contract in accordance with Ind AS 115. So I think you would have analyzed the presence of the conditions as we were reading the case study. So what do you say? Is this supposed to be a valid contract? I think the 5 conditions already mentioned to me. So what do you say in this particular case? Do you think the 5 essential elements of the contract are present? And that's great, absolutely correct indeed. I'd just like to quickly, recall the 5 essential elements which are there for a valid contract. And I think if you just, first of all, tell the examiner about the 5 essential elements, just using the key inputs to you. The first one is that the contract needs to be enforceable in the court of law. Because we always say that the contract is approved by the parties, and if it is approved by the parties, we can say it is enforceable in the court of law. It creates legal rights between the parties. The second one in this particular case is that you can say it should be very clear as far as the consideration is concerned. We should be able to clearly identify, you can say, the money terms in the sense how much money is to be paid, what is the mode through which the payments are made, and that is also very clearly given. We should be able to identify the rights of both the parties, not only the rights of the customer, but also the rights of the, you can say, seller as well. And I think in this particular case, the rights of the companies are clear that once the work is done, they get entitled to a consideration. The rights of the customer is also very clear that unless the company first understands the problem and they tell him the price, so rights of the customer is clear, rights of the company is clear. We also need to prove that there is a commercial substance as well, which indirectly, of course, means that the cash flows of the companies would undergo a change. And in this particular case, undoubtedly, yes. And once we've seen the fourth condition, there is a fifth condition as well. And what is the fifth condition? I think I'm getting the inputs. It's a valid contract. So let me now ask you, what is the fifth condition? Because we can see one is approved, enforceable. One is that the rights of the parties are clear. And what is the fifth condition? Most important, I would say. Most important, I would say, the collection is supposed to be probable in nature. Because unless the collection is probable, it cannot be construed as a valid contract. That's rightly said. And I think we can see that the contract is enforceable, the collection is probable, everything is there. So undoubtedly, yes, it is a valid contract. So when you draft your answer in this particular case as well, you just need to make a mention to the examiner with regard to the 5 essential elements which are mentioned in Ind AS 115, relates the facts of the case to those 5 essential elements in the para number 2, and then you give your final conclusion that yes, it becomes a valid contract. So far so good. I think these questions are pretty easy indeed. Warm-up exercise. Okay, now Marie, we are soon going to go on to some technical questions also with you. Okay, now before I take the journey forward, I think within this particular step itself, I want to now remind you something more as well. I want to remind you something more as well on this. So, as you are revising, I think it would be a good exercise to make some quick mind maps at the back as well. As you notice, I finish a particular subsection. I just give you, the key insights in terms of what you're learning. Now, as we went through those 5 essential elements, you should, quickly pen down that, okay, in step number 1, we've got these 5 essential elements, and these are the key terms that, once they're met, we can go to the step number 2. Now, before we go on to the question on the step number 2, there is another area, which I will discuss in between and do some questions on that. And that is the concept which is called contract modifications. The next area that is supposed to be called as a contract modification. Now, the immediate thought which comes to the mind is, I'm just, trying to take a flashback in terms of what you already know, and we're just going to make a walkthrough in terms of the key provisions on the modifications, and then we come back to the questions. Now, when you consider the concept of modification, what you need to see is that there is a change in the scope of the contract. Either there is increase or a decrease in the scope of the contract, and also there could be a change in terms of the price of the contract, and accordingly it falls under the purview of a modification. And there are permutations and combinations of the treatments which are suggested in the standard as far as modification is concerned. And accordingly, there will be a couple of different accounting treatments possible. You could land up saying it is a separate contract, of course, depending upon the kind of parameters which you meet. You could also land up saying that, we are saying that the old contract comes to an end, and we are saying that practically a new contract makes a start. And you could also land up saying that it is supposed to be what we call a cumulative catch-up adjustment. So when you look at a question on a modification, what should flash at the back of the mind is, what are the permutations, combinations, which will give you a treatment that yes, it is a separate contract? What are the permutations, combinations when you would say that the old contract comes to an end and a new contract comes into place? Or what are the cases when it is supposed to be a cumulative catch-up adjustment? I think I'm not reminding the parameters as of now. We're going to look at some questions on the area of modifications. And after we've done some questions, we'll of course, quickly pen our thoughts down and understand that, yes, okay, in these particular cases, permutation combinations, this kind of accounting treatment follows. Let's, I think, begin the journey now on the modifications part. Okay, I think I've got a question as well. So I have one request to you. If it is possible, please explain the core things of the standard in a precise manner, like mind maps, charts, before taking up the question. Okay, majority of you want me to do that as well. I think I'll go with the majority view. You want me to give you some kind of quick mind maps, but that, would of course, or maybe we can do it at the end of the questions as I'm doing, if that's fine. Okay, I think I get an answer no, so we are ready for it. That's wonderful indeed. So maybe, what we can do is after the end of the concept, I'll just quickly, give you some key point highlighters as I've been doing so far so that it gets, completely embedded in the mind. Yes, after the end of the question, wonderfully well. That's suggestion well taken. Let's, I think, now go on to the question number 5. Let me just read the facts. You need to now decide the kind of accounting treatment which would apply. It says an entity promises to sell 120 products. 120 products to a customer for 1,20,000. That's 1,000 per product. It says the products are transferred to the customer over a 6 months period. The entity transfers the control of each product at a point in time. After the entity has transferred the control of 60 products to the customer, the contract is modified. One thing which I would like to caution you at this particular stage, because sometimes when you read the question, and you read the word that the contract is modified, one tends to believe that yes, it could be a modification. Well, I would say you need to apply your judgment, because even if the question says that it is modified, you need to see that the parameters of modifications are met. Because if the parameters of modification is not met, it would be treated as a separate contract as well. So we should not be guided with the fact that if it says that it gets modified, we need to evaluate the parameters. So it says after the entity transferred 60 product to the customer, the contract is modified to require a delivery of additional 30 products, which is a total of 150 identical products. Now, whether this word identical product is giving me some kind of inputs, I would say yes. It is definitely giving me some kind of input when it says that these 30 products are also identical in nature. It says to the customer at the rate of 950 per product, which is the stand-alone price for such additional products at the time of placing this additional order. The additional 30 products are not included in the initial contract. It is assumed that the additional products are contracted at a price that reflects the stand-alone selling price. Determine the accounting for the modification contract. Now, I think before you explain the answer to me, let me, I think, put a very simple question back out here. In this particular case, the question is it a modification? Before we decide on the accounting treatment, do you think it is supposed to be a case of a modification? I think let's get the inputs at your side, because it says that the contract is modified, and that's rightly said. It is, of course, not a modification, because if you see, there are two parameters which the standard states. There are two parameters with the standard states, and that's rightly given. I think that is one of the very important words which you gave me. When you look at the concept of modification, I think the first and the foremost thing is you need to see that is the goods, the additional goods, something what we technically call distinct, or is it something which is not distinct in nature? Now, in this particular case, when I am given that the company is initially entered into the contract to supply 120 units of the product, and then it is going to supply another 30 units, which is identical in nature. So that means there is no interdependency, or you can say interrelationship, between the existing and the new additional goods. So we can undoubtedly say that the goods are distinct in nature. And once the goods are distinct in nature, the next thing is that you start looking into the two parameters. The parameter number one is that in this particular case, did the scope of the contract increase or not? And we can say definitely yes. The scope of the contract definitely increased in this particular case. Because when we are looking at additional 30 units, it is definitely indicative that the scope of the contract definitely went up. Then the second is you need to see that whether the price increase is commensurate to the standalone prices or not. And it's very clearly given that the prices which is charged for these additional 30 units is commensurate with the standalone prices as well. And if it is commensurate with the standalone prices and these two conditions are met, it indicates it is supposed to be a separate contract. And I think if you remember, I very clearly made a distinction at the very start. And I said, that when you're looking in terms of the fact that in this particular case, whether it is a modification or not, please don't get guided with the language of the question. The language might say that it is a modification, but you need to see that it is a modification or not. Because when the goods are distinct in nature and the two parameters are met, in this particular case, it is treated as a separate contract. Rightly said. So determine the accounting of this modified contract. So we're going to say that it is not a modification of the existing contract, but it is to be treated as a separate contract altogether. And you're going to apply the 5-step model in terms of this additional 30 units separately. Okay, that's wonderful indeed. Let's have a look at another question now. And again, you need to identify the inputs out here and decide the parameters. Let me read. This is also one of the questions which came in the mock test papers in April 21. So let's, I think, read the facts of the case and we'll decide. It says entity A enters into a 3-year service contract with a customer for 4,50,000, and this is supposed to be 1,50,000 per annum. The standalone selling price for 1-year service at the inception of the contract is also 1,50,000. But I think that does not make a difference to me. Because I think once I am looking at the concept of a modification, what is important is that we need to see that once the modification is made, is the price commensurate to the standalone price? Now we are given the information regarding the inception of the contract that the price entered is commensurate with the standalone price. That is not the parameter to decide a modification. Then he says A accounts for the contract as a series of distinct services. I think the examiner has made my life a little simpler. Now we can clearly see that it is supposed to be distinct goods and services. So I think we just need to identify the two parameters, whether it is supposed to be, number one, scope is increasing or not, and whether the price is commensurate to the standalone prices or not. Then he says at the beginning of the 3rd year, 2 years have already passed by, and we're standing at the beginning of 3rd years, the parties agree to modify the contract. The fee for the 3rd year is reduced to 1,20,000. And C agrees to extend the contract for another 3 years, but this is going to be 1 lakh per annum, which makes it 3 lakhs for another 3 years. Then he says the standalone selling price for 1-year service at the rate of modification is 1,20,000. Now the question in this particular case is this going to be treated as a separate contract, or are you going to treat this as a modification? I think let's get the inputs at your end. So what do you say in this particular case? Do you think it is to be treated as a separate contract? Or do you think this will be considered as a termination of the existing and we are going to consider a prospective accounting? Let's get the inputs at your side. Okay, I think I'm yet to get answers on that. Tricky, is it? Okay, so we're given that separate contract. The reason the scope is increased, I'm afraid, no. I think in this particular case, first of all, there has been a reduction in the price because Initially, the contract is for a period of 3 years and the price is 1,50,000 per annum. And now he has reduced the fees for the third year itself to 1,20,000, which means the price has actually gone down for the existing contract. So in this particular case, though you can say the scope of the contract has gone up because the period is extended from 3 to another 3 years, but in this particular case, the price of the existing contract has gone down. So this is certainly going to be considered as a modification. That's right. The price for the existing contract gets reduced, so it is not a separate contract. So once you say that no, it's not a separate contract, the next particular question what comes to the mind is what kind of accounting are we going to apply? So we can say in this particular case, it is going to be a change which is going to be accounted prospectively. Let me make a little interesting statement as well, though I will, club this in my conclusions after the end of the modification question. Can I make a strong statement at this stage that the concept of a cumulative catch-up adjustment is applicable only if the goods are not distinct? I'm making a very strong statement at this stage. So can I say that the concept of a cumulative catch-up adjustment is applicable only when you say that the contract is, not distinct in nature? Is my statement correct? Because when the goods are distinct in nature, I don't see that there is going to be any cumulative catch-up adjustment. And I think that's rightly agreed. Of course, yes. Trust me, your starting point should be to see whether they are distinct in nature or not. Now, in this particular case, if it is distinct, either you'll end up saying it is a separate contract, or you'll end up saying that this is going to be a prospective accounting. And when it is not distinct in nature, it leads to a cumulative catch-up adjustment. So what do we do in terms of accounting, in terms of question number 6? And that's rightly said. There is no cumulative catch-up adjustment which is there. Okay. Now, in this particular case, if you look at the accounting, what do we need to do? You need to consider that now in this particular case, the fees which is there for the third year is 1,20,000. The remaining consideration of the existing contract, and you add up the consideration for the additional 3 years, that is supposed to be 3 lakh. And this is going to be taken and spread over the total 4 years in this particular case. So the standard makes a clear-cut distinction that when the goods are distinct and you say it is not a separate contract, you need to consider the consideration, the remaining consideration of the existing contract, add whatever is the additional consideration, spread it over a period of 4 years. I guess this comes to 1,05,000 per annum. That's right. So now the company is going to account for a revenue to the extent of 1,05,000 for the next 4 years to go. And this is indirectly, you can say, is supposed to be a prospective accounting. This is what we technically say is supposed to be a prospective accounting. Wonderful. Okay, so this is another input on the modification. I think we can see that we've done 2 questions on the concept of modification. Now let's go on to the next one with you. So you can see the sequence that we are trying to cover up all the issues in this case, starting with the scope of the standard to the step number 1, and then on the contract modifications as well. Okay, let's go further. Okay, so could you scroll back for a minute, please? Yes, of course. So after I'm done with the question number 7, I'll just give you a quick recap of the concept of modification as well, that what kind of accounting treatments becomes applicable in which permutations and combinations as well. You're welcome. Okay, now let's have a look at a question number 7. This is also one of the questions which came in the mock test papers in October 21. Now, let's, I think, read. And as I read something, I'm going to put some outright question to you at this stage. It says G enters into an arrangement for an infrastructure outsourcing deal. My mind is working at the very start as I read this question. When I look at the concept that the customer you've entered is an infrastructure deal, my mind is telling me that the goods are going to be not distinct. Do you agree with my statement? I know it's a little too early to make these kind of statements, but as I read that it is infrastructure, I think you rightly agreed with me. Yes, of course. Because what happens in terms of an infrastructure, for example, you're constructing a building. In this particular case, I think you'll vouch me for this, that in this particular case, there will always be an interrelationship, or you can say there will definitely be some kind of modifications, which will be required to the existing goods. For example, if I were to construct an additional room within the agreed contract, so initially, let's say I agreed that there will be 3 rooms in the particular building. Now we agreed that no, we're going to add another, room to the particular building. So it would always land up being, you can say, not distinct in nature. Now, based on the experience, G determines customizing the infrastructure will take approximately 200 hours in total, and the charges are 150 per hour. After incurring 100 hours of time, that means 100 hours of work is already done and 100 hours of revenue would have been recorded as well. It says the customer agreed to change an aspect of the project and increase the estimate by 50 hours at the rate of 100 rupees per hour. I think we can again make another interesting statement as well. So can we say, and like a work contract, you said teaching service, security service, etc.? Yes. So in this particular case, can I say, since it is a case of goods which are not distinct, can I outrightly say that there will be a cumulative catch-up adjustment? Because I think if the goods are not distinct in nature, the only accounting treatment applicable is that the goods, that is cumulative catch-up adjustment. So I think let's do one thing first of all. In this particular case, let's do the working. Can I say initially it was agreed that 200 hours will be charged at the rate of 150, and I think that works out at 30,000. And you can also see that another, we've agreed for another 50 hours at the rate of 100 per hour, and that works out at 5,000. So when you do a cumulative catch-up adjustment, we need to incorporate the adjustment as a part of the existing contract. So we can say the total consideration is 35,000 and the total hours is going to be 250, and you can get a weighted average calculation. So 35,000 divided by 250, that works out at 140, that becomes a weighted average. And there is something which I would like to pinpoint at this particular stage, and I think you will definitely agree with me at this stage as well. One thing which we need to be very clear and cautious about is, in the previous question number 6, when you said that we are using the concept of, a weighted average, because even in the question number 6, it was a weighted average. But that weighted average was considering the remaining consideration for the existing contract. But in this particular case, you have taken the entire consideration. So remember, when it becomes a case where the goods are distinct in nature, then in that particular case, we consider a weighted average, but it considers only the remaining consideration. You can understand what I mean by remaining consideration, because if you go back to the question number 6, while considering a weighted average, in this case, I took 1,20,000, which is the remaining consideration for the existing contract. But when it comes to a cumulative catch-up adjustments, you'll end up taking the consideration for the entire contract itself. Now it is making a comparison. What revenue the company has already booked in the past. The company has already incurred 100 hours, and they must have taken a revenue at the rate of 150 per hour. That works out at 15,000. And now, if I go with the cumulative catch-up adjustment, we should have taken a revenue at the rate of 140 per hour. So we should have taken a revenue to the extent of 14,000. So what do I do with this change of 1,000? Is this decrease going to be recorded on a prospective basis? Are you going to record this in the year of modification? Yes, of course. This decrease in the revenue is going to be captured in the year in which the modification takes place. Okay, now I think it's time to connect the dots once again with you. So I think let me just come back and connect the dots once again with you. So I guess if I just, try to map up my mind in terms of things, I think I can still, maybe use my board at this stage. Let me know, friends, if this is clearly visible. At least I can use it to make the quick mind maps. If I write something, just let me know if this is clearly visible to you or not. So 1000 reversed in the year of modification. That is absolutely correct indeed. Absolutely correct. So I guess if I just make a quick mind map on this, please let me know if the board is clearly visible. Otherwise, I'm going to change the setup later. I hope the handwriting is visible now. Now it is very clear. Okay, so maybe I think the Word document needs change. Don't worry, I think I got the problem. Solution will be arranged, of course, not an issue. Okay, that's great. So in this particular case, when I'm looking at the concept of modification, if I just quickly make a little mind map, we can say that there are basically two cases. One is you need to see that the goods and services are distinct in nature. And one is you need to see that the goods are not distinct in nature. So once you decide that the goods are distinct in nature, then you need to be cautious and apply two parameters. So when you say that they are distinct in nature, you need to consider the two parameters. Then you need to apply the two parameters, just making a quick mind map to you. And the two parameters is you need to see that the scope increases. That is a parameter number one. The second is that the price also increases and it needs to be commensurate. And it needs to be commensurate to stand-alone prices. It needs to be commensurate in accordance with the stand-alone prices as well. So these two parameters need to be seen. And once you look at these two parameters, then you need to see that if both are met. So then you need to see that are both the parameters met, or you can say the parameters any one or both fail. Any one or both the parameters fails, then what is to be done? Now, when you say both the parameters are met in this particular case, we can outrightly say it is supposed to be a separate contract. That is the very first question which we did. And when you say any one or both fails, then in that particular case, it is supposed to be a prospective accounting. We consider the existing contract comes to an end and a new contract is started. And that's what we did in the other question. And when you say that it is not distinct in nature, the only accounting treatment is supposed to be what we call cumulative catch-up adjustment. This is called cumulative catch-up adjustments, where the increase or decrease is captured in the year of modification. So this is a quick mind map as you requested on the concept of modifications of a contract. Wow. So I think that's what I think was requested for. So I thought, as we finish each section, we can just, quickly do some mind mapping to you as well. Okay, wonderful indeed. So we're done with the scope of the standard quick inputs, though I didn't document that mind map, but I gave you the inputs on the scope of the standard. Then we worked upon the 5 essential elements in terms of step number 1. And then I've given you the inputs on the modifications. Now, let's go on to the step number 2. Our crucial questions are going to be on the area in terms of step 3. I think that's one of the areas where we need to work upon. So we'll just quickly go through the step number 2 without taking much time. And then I think we'll go on to the step 3. That's the area we need to spend time. There are 2 wonderful questions awaiting you. Okay, let me just share the screen back again. You're most welcome indeed. So let me just share the screen back again and let's go further to the question number 8 now. Now, I'm just reminding you the inputs without, giving you much inputs on that. In step number 2, when you say identify the performance obligations, Your mind needs to start working that yes, you need to evaluate the contract both from the point of view of the entity as well as the customer to decide, whether the performance obligations of one more than one as the case may be. Let's, I think, read the question number 8 on step number 2, identifying the performance obligation. It says N enters into a contract to build a house to a customer. N is responsible for the overall management of the project, identifies various goods and services that are provided, including architectural design, site preparation, construction of the house, plumbing, electrical services, finished carpentry. So it is comprising of a plethora of goods and services. But that is promises. But whether every promise is going to become a performance obligation is what we need to evaluate. It says N regularly enters into such contracts with the customer to sell the goods and services individually. How many performance obligations are there in the contract? I think let's get the data from you. So in this particular case, you have entered into the contract to build a house. A couple of services are there. Then he tells me that the entity is regularly entering into contract with the customers, supplying each of these goods. It says individually to them. So how many performance obligations are there in this particular contract? I'm yet to get some inputs on that. I think this is one of the steps, which becomes the most dangerous one for people to understand. But I think I remember a few questions, of course, are there, which are, assessing your abilities to see the number of performance obligation. I got the answer single. That's absolutely correct. And it is one performance obligation, correct. Now, just to, give you the insights in terms of how the decisions has been made. The first thing what you need to do in this particular case is you need to put a question to the entity that is the entity regularly selling all these goods on a standalone basis, and the answer of course is a yes. Because when you look into the identification of performance obligations, your first stage is that you need to first of all, ask a question to the entity that are they selling on a regular basis? All the products which are bundled together, are they selling them on an individual basis? And the answer is a yes. Now, would you like to give me one key word, when I'm going to look at what the customer demands? Because once you've made the assessment from the entity's point of view, the next assessment is required from the customer's perception. And when you look at the customer's perception, can you give me that one key word which is indicating that there is a single performance obligation? Can I use that word contract level, or can I use the word that there is going to be a significant integration required? Because when these kind of words are used in the exam, this is important, because in this particular case, we can say the customer is demanding significant integration of all the goods and services into a single output, because all the activities, all the goods and services are going to become an input in terms of a single house to be built. So we need to make this mention that a significant integration of all the goods and services are required, and therefore we can conclude that it becomes a single, that is one performance obligation. Wonderful indeed. Okay, let's go to the next one now. Let's look at the question number 9. Now, in terms of the question number 9, it says an entity P grants a customer a 3-year license to an antivirus software and promises to provide the customer when and if available updates. So we can very clearly see in this particular case that there are supposed to be two kinds of services which are being provided by the company to the client. They say that we're going to give you the antivirus software, number one, and apart from that, I've highlighted the word and, also to give him updates as and when they're available. It says P frequently provides updates that are critical to the continued utility of the software. Now, without these updates, it says the customer's ability to benefit from the software would decline significantly during a 3-year contract. Is the antivirus software and the updates considered to be distinct performance obligations or not? So in this particular case, again, I think your assessment would be required at both the ends. I think if you look at from the entity's perspective, do you think that the entity would be selling, the software without the updates as well? I think looking at the kind of customers, we can say definitely yes. The entity might be selling packages and they might be selling packages to customers without updates. There might be many customers who are not willing to pay the money for the critical updates, even though they know that it is critical. So they may be regularly selling all these products, with and without the updates both. Now, in this particular case, would you like to give me a keyword? Would you like to give me a keyword? That what kind of keyword am I going to use? You rightly said it is a single performance obligation, but would you like to give me what would be the keyword with which I would conclude that it is supposed to be a single performance obligation? Because the standard has used 3 different terms from the customer's perception. One is significant integration, as we saw in the previous example. And in this particular case, we can say significant modification. The word which is required to be used is significant modification. No, I would not say interdependency. I would say it is significant modification. Because as the updates will be provided, it will significantly modify. It would significantly modify, you can say, the software. So when you say that when the additional goods and services are provided, it will significantly modify the, you can say, initial goods and services, and therefore you can say it becomes a single performance obligation. There are 3 terms which are used in the standard. One is significant integration, one is significant modification, and one is the concept what we call highly interrelated and interdependent. I would say they are the 3 crucial words which decides the fate. I think let's go on to the next question with you now. It says company A is an auto component supplier and supplies auto parts to original equipment manufacturer. It has received a contract to make a tool for a total consideration of 5 lakh. The tool requires the design to be created and approved from the customer, and then the process of manufacture of the tooling begins. So there are 2 activities which are required. One is in terms of manufacture, and that is designing, So we can say one of the services to be provided is designing, and the other is the manufacture. This process is completed in a short period of time, around 1 month. So are we considering the designing and are we considering the tooling as a separate performance obligations or not? So in this particular case, I guess if you look at the entity's perception, I think from the entity's perception, we can undoubtedly conclude that the entity might be, providing separate services. There might be many customers coming to them requiring only designing. Or there might be many customers coming to them who might be requiring a tooling, because in a varied situations, you should always assume that customers would be of different varieties. I may have customers who come only for designing. I may have customers who come only for tooling. And in this particular case, from the entity's point of view, they might be regularly selling things. But what does the customer want? So would you like to give me a particular word in which case I can define that whether it is a single PO? That's rightly said. It is a single performance obligation. Not significant integration. I think here the word goes highly interrelated and interdependent. Highly interrelated and interdependent. I think that would be a more appropriate word to use, which will indicate that there is a single performance obligation. Wow. I'm just going to again stop sharing the screen to just make some quick dots, connect the dots back again out here. So I think I'll just come back on the agenda and just connect the dots once again out here. So now if I just, try to map up my mind on the step number 2, I'll just quickly make a quick mind map chart to you so we can just connect the dots as I did for the earlier version as well. So I think in this particular case, if I just try to make a quick mind map, in terms of the step number 2, this is in terms of the step number 2, where we're looking at identification of the performance obligation. I would say you just need to mind some crucial points at the back of the mind. And what are those crucial points? Now, there are two things to be seen. One is you need to look at the entity's perception. One is that we look at the entity's perception, and the second is we need to look at the customer's perception, that what does he want. So one hand, we need to see the entity's perception, and the other hand, we need to see that what does the customer want. Now, from the entity's point of view, you need to basically evaluate in this particular case that is the entity regularly selling. The first keyword is that they are regularly selling. Now that's a very important word. That they should be making the sale of those goods and services within a bundle on a regular basis. And the second one is that they're regularly selling, you can say, each goods and service in the bundle. So you need to basically look into the two parameters, that are they regularly selling each goods and services separately. So if you say the answer is, let's say, a yes, or the answer is supposed to be a no. Well, in rare cases, you will get the answer no. If the answer is no, then undoubtedly in this particular case, it is a single performance obligation. Because if the entity in itself is not selling these goods on a regular basis and on an individual basis, that means they're always selling things as a bundle. It would be a single performance obligation, no further analysis required. But if you say yes, in this particular case, then it's time to look into the customer's perception at this stage. And when you look at the customer's perception, there would be 3 permutation combinations to be seen. Though the standard gives us this as an illustrative list, but then you need to find out if the customer wants any one of these 3. If the customer wants any one of the 3, it is a single performance obligation. So you need to see that, is he requiring a significant integration? Is he requiring a significant integration? The word is important. The word is significant. The word is integration. Or is he requiring, does it mean that it will significantly modify the earlier goods and services? Or the third one is that these goods and services are supposed to be highly interrelated and interdependent. Highly interrelated, or you can say highly interdependent in nature. And if any of these parameters is met, any one is met, in this particular case, it will become a single performance obligation. So in other words, we can say that if none of these conditions are met, there will be multiple performance obligation. So this is looking at the customer's perception in terms of what he desires, in terms of what he wants. Now, that is a quick mind map in terms of looking at the entity's perception, what keywords are to be looked into, the customer's perception, what keywords are to be looked into. I think that's what you requested. I hope we are going at the right track, giving you the questions and then, just trying to quick mind map on the key issues on the standard. So far so good. I think this was the easy part of the standard. In which particular case you can see we've done the step 1, we've done the step 2. Now it's time to take you to some more interesting questions at this stage. Now you will see the level slightly increasing, of course. Let's take it further. Okay, so let me, I think, take this further. So thank you for the 3-step models in many cases, like your mind maps. Thank you very much indeed. Honor. Okay, so let's, I think, take this further. I am now going to share the screen back again. Now I think it's interesting to look at a very interesting question indeed. This is an examination question which came in November 2020, 14 marks in the exam. I think if you ask me, one of the most interesting questions which has come in the exam Sorry, mind map, please. I'm afraid. Just a second, sorry. So, I would say that this is the question which we're doing is one of the most, I would say, interesting questions which I've seen in the exam. It is, of course, one of the brilliant questions which is there. Right, I guess done. Okay, let me, I think, share the screen back again. So let's, I think, have a read on this particular question. It's a November 2020 examination question, came for 14 marks. I think let's read this question out here. Now, very carefully, I remember, when this question came in the exams, many people gave a very short answer in the exam. It's a brilliant question indeed. It says in the question, ABC Limited supplies plastic buckets to wholesaler customer. As per the contract entered between ABC and a customer for the financial year 1920, the price per plastic bucket will decrease retrospectively as the sales volume increases. As the customer is going to buy more buckets, we're going to reduce the price of the buckets, and we're going to reduce the price, it says, on a retrospective basis, which means the price of all the earlier old buckets sold will also go down. And that becomes interesting. So I think immediately what should come to the mind is that, can I say that this indirectly becomes a case of, you can say, a variable consideration? Because you are giving a discount to the customer, and when you're giving a discount to the customer, that is undoubtedly a concept of variable consideration in the transaction price. Then he says the price applicable for the entire sales is based on the volumes in the bracket. So if you're going to sell 10,000 units, the price is 90. If it is going to be between 10,000 to 35, it's 80. And if it is more than that, then it is 70. Now it says there are a couple of requirements in the question. Suggest how the revenue is recognized in the books of accounts of ABC as per the expected value method. Considering a probability of 15%, 75%, and 10% for a sales volume of 9,000, 28,000, and 36,000 units respectively. He's given us that there is a probability of 3 different volumes of sales to be achieved. And he says that you need to consider the concept of expected value method. For workings, assume that ABC achieved the same number of units of sales to the customer during the year as initially estimated under the expected value method. I think let's first read the question, then we'll come back to the individual requirements. Then he says, in case ABC decided to measure the revenue based on a most likely method, that is MLO, instead of expected value method, how would the revenue be recognized in the books of accounts of ABC? For workings, assume that ABC achieved the same number of units of sale to the customers during the year as initially estimated under the most likely method. Now you can very clearly see that the first requirement of the question is based on expected value method. And the second requirement is based on most likely method, because there are 2 methods which are given in the standard, which tells you how do you recognize revenue in terms of a variable consideration. Then he says you're required to pass journal entries in the books of ABC if the revenue is accounted under the expected value method. So we need to explain how would the revenue get recognized in the first case without entry. Then we need to give another case, how would you recognize revenue in the other case if it is a most likely outcome. But the entries have been required only in terms of the expected value method. I think let me use my board in terms of explaining the answer in this particular case. So I think I'm just going to solve this on the board with your help itself. Okay, let's, I think, begin the journey. So let's, I think, see the nitty-gritties in terms of this. I think I'll need your help in terms of the data. I guess this is question number 11. Okay, so we're solving the question number 11. Now, first of all, we are very clearly given that the first requirement is based on EVM, that's expected value method. Now, since it's a 14 marker question, I think we need to tell the examiner also that I'm not documenting all that part, but you need to definitely tell the examiner that this involves the concept of a discount, and you need to tell him that discount becomes a concept of a variable consideration. Now, first, the question in the first requirement is focusing on expected value method. Now, let me first of all tell you one thing which you need to clearly bring out in the solution. There is one particular aspect which you need to clearly bring it out to the examiner in your solution. I would say the focus in requirement number A is not on the journal entry. The focus in requirement A is in terms of how would you recognize your revenue. So you need to clearly tell the examiner in terms of what is the revenue recognition policy of the company. Now, there are two components of recognizing revenue. One is the volume and one is the price. So at the first instance, what you need to define is how much is the expected volume, and number two, what is the expected price. So we're going to work on two things. We're going to first of all work on the volume. And for the purpose of the volume, we are very clearly given the data. There are three volumes which are defined in the question. So 9,000, 28,000. So we're given 9,000, 28,000, and we are given it is 36,000. And there is a probability which is attached to each of these volume, and that is supposed to be 15%. 75% as well as 10%. So what we can do, we can just take a weighted average of all these volume. So I think you'll have to do the calculations to me in this case. So if you just work this out, we're going to get a weighted average volume. So this is one element of recognizing the revenue, that what is the expected volumes in this case. So 9,000 into 15%. That's 1350 plus 21,000 plus 36. I think this comes to 25,950 units. That is the expected volume which we are expecting based on the probability given. That's absolutely correct. The next is also to decide the price at which the revenue recognition would take place. Now, in this particular case, when you're considering the price, you need to consider these volumes, look at the ranges which are given in the question, and identify the prices for each of these volumes and get a weighted average. So in this particular case, when you're looking at the price, 9,000, 28,000, and 36,000, let us see the prices applicable to each of these ranges as well. The first one, 9,000, is in the first slab, so the price is at the rate of 90. And then the next one, that is 28,000, is in the second slab, the price is at the rate of 80. And the last one, 36,000, is in the third slab, and this is 70. So we need to first get the sales in value. We need to first get the sales in value. So 9,000 into 90, that works out at 8,10,000. Then it is 28,000 into 80, that works out at 22,40,000. And 36,000 into 70, that works out at 25,20,000. So this is the sales which is there. This is the sales in terms of value, and this is the volume. So what we're going to do, we are to consider the sum total of the volumes and the sum total of the values, and based on this we can get a weighted average price as well, because since we're looking at a price, we need to organize a weighted average price. So 8,10,000 plus 2240, and this is going to be 2520, that works out at 5570. Or we can just take a weighted average maybe. 5570. Sorry, we missed out the probabilities in between as well. I think we need to take the probabilities also into account. So in this particular case, I guess, so let's consider the probabilities as well. So this is going to be 15%. This is going to be 75%. And this is going to be 10%. So let's consider the probabilities as well. 8 lakh 10, 15%, 121,500, 18,01,500. Is this coming to 20 lakh 53,500? And we can divide this by the weighted average units itself, 25,950. I guess comes to 79.13. Is that so? Is the weighted average just sec coming to 79.13, I believe? That's right. So this is the weighted average. So what we have done, we've taken the sales value based on the probabilities, and this weighted average is already given out here. So once you take the weighted average, we get the figure of price, which means on the expected volume method, we can clearly tell the examiner that this is the volume expected and this is the rate at which the revenue recognition would take place. But I think we need to still give some more inputs at this stage. So let's, I think, go further. So continuing the inputs in terms of expected value method, let's call it as EVM. So we need to tell the examiner that, in requirement number 1, when you're indirectly asking me a revenue recognition policy, we can say we need to recognize a revenue of 25,950 units. And the revenue is to be taken at the rate of 79.13. Now, you cannot stop at this particular stage. You also need to tell the examiner that out of this 25,950, how much are you collecting at each stage and how much revenue are you recognizing at each stage. Now, if you go back to the question and look at the slab, I think I will just share the slabs for the time being. In this particular case, you can see that the first slab is for 10,000 units. So that means every time the company is selling up to 10,000 units, they will be getting a revenue. They will be getting a collection at the rate of 90. So we can split that 25,950 into two components, the initial 10,000 units, and then we can say the balance, which is 25,950 minus 10,000. So in this case, the collections will be at different rate. So we'll tell the examiner that when you're going to take a revenue based on this 25,950 units, we will basically split this in two parts. You can say for the initial 10,000 units, we'll be selling them at the rate of 90. And for the extra 15,950 units, in this particular case, you will be getting 80 rupees per unit. So you need to tell the examiner that we need to split our entries based on these two separate movements. Because of the slab, the collections will be different, but the revenue recognitions will be different. I think since in the third part, he's asking for entry as well, let's, I think, do the entry at this stage itself. So if I look at the journal entry, which will be done under this particular method, can I say the entry for the initial units will be bank gets a debit and you go to get the entire 90 rupees from the customer. The bank will be with the amount of collection, but the revenue is going to be based on the weighted average price. So in this particular case, 10,000 units, we will collect 90 rupees per unit. So this is what the collection is going to be. But when it comes to recognition of revenue, the revenue will be recorded on 10,000 units at the weighted average, which is 79.13, which we've identified. So where do you take the difference? Whatever is the excess collection which is done from the customer, where do you take that excess? which account are you going to park this excess money? So I guess if I take the difference, this is coming to 10.87. That's a balancing figure. So which account are you going to park this? That's right. You're going to put this in the contract liability account. We're going to temporarily park this in the contract liability account. So I thought maybe we can just add the answer to the C part at this stage itself. So when the company is going to recognize revenue, the collections will take place at the rate of 90 for the initial 10,000 units. But later, but the revenue will be taken only to the extent of the weighted average price, 79.13. So whatever excess is there, that stands in the contract liability at this stage. Okay, now the question arises, what will you do with this contract liability? Can I say this contract liability will be adjusted at the time of year end? Because as you're going to sell, maybe there is excess money which needs to be repaid back to the customer. So once that excess money needs to be repaid back to the customer, so at the end of the year, we're going to put the entry contract liability gets a debit and the bank gets a credit. In fact, I would also like to pinpoint an input which was given in the suggested, just for a little discussion point of view. There were two alternative accounting treatments which were suggested in the suggested answer as well. One is that you pass a consolidated entry. Now, when you put a consolidated entry for 25,950 units, then in that particular case, I think it will not be a technical position. But I think the better one is that in the second alternative, you give an entry for the initial 10,000 units, then you put another entry for the 15,950 units. Now, when you put the entry for those additional units, that's the point what we need to see. So I think I like to work that out. So this is the entry which is done for the initial units. Now let's also see the entry which we are going to do for these 15,950 units as well. Now, when you go to sell these 15,950 units, there are going to be two permutations combination. One is the customer pays you 80 and then you're going to pay the money back to him. Or the other is the customer says, I'm going to adjust the difference right away. So you can show two alternative treatments for these additional units. See what? When you're going to look at the entries for 15,950 units, I would say there are two alternatives, alternative 1 and there is alternative 2. The first entry is very simple. You collected 90, you took a revenue to the extent of 79.13, done. But when it comes to this additional 15,950 units, you've got two set of assumptions at the back of the mind. The customer says, I will pay the balance only. Or the customer says, okay, I'll pay you at the rate of 80, then you can pay me the money back later. So let's say the first alternative is customer pays the difference. Customer pays the difference at this stage. He says, I am only going to pay you the difference at this stage. Now, for total 25,950 units, what is the amount the customer is liable to pay? Can I say 25,950 is in the second range? And I think what is the amount price which will be applicable? Is it 80, right? He is liable to pay, I think, at the rate of 80. Is that thought correct? So this is the total which he is liable to pay. He's already paid on 10,000 units at the rate of 90. So what is the amount he is going to pay at this stage? This is what he is already paid for the initial units. He says, I'm liable to pay you 80 rupees for all the units put together. So he says, I am going to adjust the difference. I'll pay only the difference to you. So 25,950 into 80 minus this 9 lakh, it comes to 11,76,000. So he says, I am going to give you only the differential at this stage. I will adjust the balance. So the entry in this case is bank gets a debit. Can I say to the extent of 11,76,000? And revenue gets a credit, and revenue will be given a credit at what amount? Can I say this will be 15,950 units at the rate of 79.13? Correct. And where are you going to make the adjustment? So this, I think, works out at 1262,124 approximately. 79.13 was correct, right? Yes. So where are you going to put the difference in this ledger account? Can I say the difference in this case is going to be adjusted in the contract liability? So see what is the balancing figure in this entry that will be adjusted at this stage. So is it coming to 86,124 approximately, I guess? This is the debit in the contract liability. Just check this. So we're taking the money which we receive from the customer based on the difference, right? And we take the revenue. Now the question is, there is still a balance in the contract liability. Can I say at the end of the year, what will you do with that contract liability balance? Because you had a contract liability, you've adjusted some contract liability at this stage, but there is still some pending balance in the contract liability. Will that be, in this particular case, taken to revenue at the last stage? Correct. So we can say any balance. So we can say any balance which is there in the contract liability will be adjusted at year end, and you can record that money later. Okay. So now let's go to the second alternative. The second alternative in this case is the customer pays full amount. The customer pays the full amount itself. He says, no worry, I'll pay you at the rate of 80. You can keep giving me the difference. You can keep giving me the difference. So he says, I'll pay you the entire 80. So bank gets a debit. For the additional units, he pays you at the rate of 80 itself. And we record the revenue. And the revenue is recorded at 15,950 units at 79.13. And the difference again is going to be adjusted in the contract liability itself. So this is going to be 80 minus 79.13, that's 0.87. So this will get adjusted at this stage. So this is a situation where we can say the customer says, I'll pay you the full amount itself at the rate of 80. The revenue is taken at the weighted average price, and the difference gets, adjusted in the contract liability. Later, the money in the contract liability that can be paid back to customer. That can be paid back to the customer at a later stage. Since he's paid the full amount of money, you can repay the difference back. So I would suggest, considering the weightage of the question for 14 marks, it's a good idea that you give both the set of entries to the examiner, because the initial 10,000 units sold, there is a single entry itself. But when you're looking at the entry for those additional good units sold, you can give both the alternative that if the customer pays the full amount, how does the contract liability get adjusted? And if he says, no, I'm going to pay only the difference, how does the entry gets adjusted in that case? So this answers requirement A and the requirement C. Now we need to answer the requirement B, which is on the most likely outcome. Okay, so I think let's go to the next input now. That is most likely outcome, that is MLO. Now, in this particular case, the question arises, when you are going to consider the most likely outcome, how would I make the selection? You need to see the probability which is attached to those three outcomes given. I guess if I just go back, I feel the first alternative is appropriate. Yes, I think the customer would always make adjustment for the excess, undoubtedly. So 9,000, 28,000 and 36,000. So we've given 9,000 units, 28,000 units and 36,000 units, and the probability attached was, I guess, 15%, 75% and 10%. So would you like to tell me which is the outcome which is most likely to happen? Which particular outcome has got the highest probability of occurrence? Can I say this is the, you can say, possible outcome which has got the highest probability of outcome? So we can say based on this, 28,000 units becomes the number of units. And what is the price which will be recorded? You're going to see the 28,000 in this slab, and I think in this particular case, the price is supposed to be 80 rupees per unit. That is the price. So if the company wants to take a revenue recognition based on the most likely outcome, they would consider the option which has got the highest probability of outcome, and they will also indicate the price. Though let me also tell you that in the suggested answer, it was also suggested that instead of taking this volume at 28,000, we pick up the volume based on the expected volume and we take the price of 80. But I think both are correct. Because considering the concept of most likely outcome, you're looking at the outcome which has got highest probability of outcome. So even if you say 28,000 units, it is correct at the rate of 80. Though it was also given that an alternative, instead of taking 28,000 units, you'll end up taking 25,950, which we have worked out on the basis of EVM. So that answers the revenue based on EVM, the revenue based on most likely outcome, and the journal entries which are based on expected value method only. The question did not ask us entries based on M&O, only the entries based on expected value method. So this was one area in terms of step number 3, which is on the concept of a variable consideration. There's another beautiful question which came in the exams, and that was on the concept of a significant financing component with you. But I think we'll just give you a quick break, I think 10 minutes, before we can start commencing with that another interesting question. Though I think the journey so far since morning has not been very technical. Ind AS 115 is not a very technical standard compared to some of the more critical standards and all. But I think still, I think the mind would need a little rest. So I think we'll take a 10 minutes break, and then I think we'll commence back with the question on significant financing component in step 3. Enjoy your break, friends. Thank you very much indeed. Ajay. Welcome back, friends. I guess you had a relaxation of mind. So we were discussing the question on step number 3, which is on a variable consideration. A very similar, interesting question came in the exams that was on another aspect of transaction price, and that is on the significant financing component. Now I'm going to take you to that particular question, which is also a past examination question. Let me, I think, first share the screen. We're just going to first read the question out. I think there are only two interesting questions which are there on Ind AS 115, and one of this question that is there is question number 13. This is examination question January 21, and it came for 12 marks in the exam. So let me, I think, make a walkthrough in terms of this part. It says A is a company which is in the business of manufacturing engineering machines and providing after-sales service. The company entered into a contract with Mr. Anik to supply and install a machine which is namely model PI on 1st April 18. So the machine is going to be supplied on 1st April 18, and to service this machine, it says on 30th September 18 as well as 1st April 19. Be careful with the dates. The machine is being supplied on 1st April 18, that's at the beginning of the year, and the service is being done, you can say 6 months later on 30th September and on 1st April 19. The cost of manufacturing the machine is 1,60,000. Now this is the cost of manufacturing the machine. It is possible for a customer to purchase both the machine and the maintenance separately. So if you can buy the machine separately and you can buy the maintenance service separately, I think it goes without saying that it would be treated as a separate performance obligation. Mr. Anik is contractually obliged to pay 4 lakh on 1st April 19. So I would say this becomes indirectly the transaction price. But he is supposed to pay this on 1st April 2019. That is 1 year after the machine is supplied. The machine is being supplied on 1st April 18 and the services are provided 6 months later, and the consideration is paid at a later date. Then he says the prevailing rate for 1 year credit granted to the customer is supposed to be 5% for a period of 6 months. As per the experience, the servicing of the machine model sold to Mr. Anik is expected to cost A Limited 30,000 to perform the first service and costing 50,000 to perform the second service. Assume the actual cost is as good as the expected cost. When A provides machine services to customers in a separate transaction, it earns a margin 50% on cost. That means when you're charging to the customer on a standalone basis, you take your cost at a 50% margin, you will be able to get the standalone selling price of these services. It says on 1st April, the cash selling price of the machine is also given. So you are given the costing of the services, you are given the price at which the machine is sold on a standalone basis and the transaction price as well. The promised supply of the machine and the maintenance services are satisfactorily carried out by the company. Now let's see the requirements of the question. There are 4 requirements put together. So one is, it says separate the components of the transaction. You know, if you look at this word keenly, there is some interesting insight which comes. You know, if you notice, the step number 2 in Ind AS 115 is identifying, you can say, the performance obligation. Here, the examiner is not asking you to identify the performance obligation. He is saying that I want you to give me the components of the transaction. So let me put it like this. What you do in step number 2 of the standard is to get the performance obligation that is also a component of the transaction. And what you do in terms of step number 3 is to identify the financing component when it is significant in nature. It is financing component. So I think one needs to be very careful. When we read the inputs, it says you need to segregate the components of the transaction. So I would say components can be interpreted as not only the performance obligations in step 2, but also the financing component in terms of step 3. So there was a little untraditional way in terms of putting the question to the students. Instead of saying that I want performance obligation, because performance obligations would restrict you only to the step number 2. And he said, I want the components, so that would mean not only the performance obligations, but the financing element as well. Then he says, calculate the amount of revenue which must be allocated to each component of the transaction. Then he says, we also need journal entries to record the information set out above in the books of A Limited for the year ended March 19 and for the year ended March 20. And then it says, draft an extract showing how much revenue could be presented and disclosed in the financial statements for both the years March 19 as well as 20. So the requirement of the question is, number 1, to segregate the components. Number 2, the allocation of the TP to the various components. Then looking at the journal entries and looking at the extracts of the financial statements. I think once you're done with the entries, then making the extracts of the financial statements is not going to be a big job. Okay, now before we solve, I think let's put across a few questions to you at this stage. When you look at the presence of the financing component in the transaction, can I say the first thing what comes to the mind is the time gap. The first thing what we look at is the presence of the time gap. Can I say the time gap in terms of transfer of control of goods and services and the collection is exactly 12 months. I would not even say that it is more than 12 months. I would say it is exactly 12 months. So if it is exactly 12 months, would that lead to the presence of a financing element? Because many people tend to get confused on the timelines as well. They generally think that if it is more than 12 months, then there is going to be the presence of financing element. But in this particular case, when you say it is exactly 1 year, would that give rise to a financing element? Yes. I would say it is 1 year and more. If your time gap between the transfer of control of goods and the collection is 12 months or more, that's right, it becomes a case that there could be a presence of a significant financing element. Now, just to give you the dots clear, you also know as you read the question that there are certain cases where we do not segregate the financing element. There are a couple of exceptions which are given in the standard, in which case, even though the time gap is 1 year or more than 1 year, we do not segregate the financing element. But I think in this particular case, we don't see any of those exceptions. The exceptions are like, for example, if the consideration is majorly variable in nature, that's not the case. We are not considering, in this case, there are no trust issues between the company or the customer. So I don't see that it falls under the case of exceptions. But the only important thing is to prove that whether there is a financing component which is significant or not. Now, I think let's start solving this to you. So let me, I think, solve this back on the board. Let's have a look. Now, when I looked at this question for the first time, I thought this is a very interesting way of testing the people in the exam. Because generally what happens that, the time gap is simply supposed to be a flat time gap. When I say flat time gap, it means you transfer the control of goods today and the collection is done later. But what is happening now is you are transferring control periodically. You are transferring a control which is on a periodical basis. Now, in this particular case, I would say the easy way of doing this is just making, let's say, a customer ledger. You could either make a chart or you could make a customer ledger. And I think for ease of understanding, I'm just going to make a customer ledger and see how the movements are happening on a date-wise level. So let me just keep the question in front of me. And I think let's start working on the nitty-gritties, the details. So we're looking at question number 13. So the first thing what we're doing is we are working on that, is the financing component significant or not? The first thing what you need to prove to the examiner is that, is the financing component significant or not? Now, in this particular case, as I said, there is already, of course, a time gap. There is already a time gap of 1 year exact. So time gap is there, but we need to prove that there is an interest element which is significant in nature. So I think the best way to do this is just make a customer ledger. Now, in this particular case, if I just make a customer ledger, let's say I'm making a debtor ledger on a date wise. I would build the customer, and this customer ledger will also help you to make journal entries on a very easy basis as well. Now, we transferred the machine on 1st April, that is X8, I guess. So we transferred the machinery 1st April 2018. So 1st April 18, we transfer the machine, which means the day I transfer the control of the machine to the customer, I'm ready to bill him, I'm ready to recognize a revenue. So I'm not making a absolutely correct ledger, I'm putting it as machine. Now the question rises that when you're going to recognize a revenue, you are going to recognize what revenue? Of course, not what you're going to collect, but there is a price which is a cash selling price of the machine. So you are going to record that cash selling price as a revenue on 1st April. So let's see what is the cash revenue. That's right, we're going to consider the cash selling price. Towards the end, it is given 251,927. This works out at 251,927. So this is the amount at which the revenue is going to be captured on the 1st April 18. Now, we need to go on a date wise. After 1st April, it was on 30th September that maintenance services are provided. So what we're going to do, before 30th September, we are going to first charge interest on this money. On the presumption, we're doing this ledger account on the presumption that if there is a significant financing element. So we are going to charge the finance income, interest will be taken. And remember, the interest rate which is given in the question is 5% for a period of 6 months. We are safe. We don't need to take it on a proportionate basis. So 251,927, we take a 5%, that works out at 12,596. That is the interest. So we'll tell the customer indirectly for our understanding that you're not making a payment, so I'm charging you interest. Then comes again on 30th September, you are providing maintenance services. So let's bill him for the maintenance service as well. And for the maintenance service, I am given some detail. Let me share the question once again. If you read the last para, it says the service is going to cost A Limited to the extent of 30,000. And he's got to practice that when he bills the customer, he adds a 50% margin on cost. So can I say 30,000 is the cost? He adds another 50% margin. I think that works out to the extent of 45,000. So for the maintenance, we will charge him 45,000. Now, the next is on 31st March, though the next maintenance is on 1st April 19, but I think just to keep the date same, we're just going on 31st March. Now tell me, on 31st March, you are going to take interest on which figure? Are you going to consider the interest on the sum total of all this information? What do you say? Are you going to consider the interest on the sum total of all this information put together? Because as of now, this is my debtor's ledger. So this is the money which he owes me on this particular date. So I will say, I'm going to charge you even interest on interest. And that's right. No, of course, yes. So 251,927 plus 12,596 plus another 45. And this is going to be the sum total. I'm taking a finance income. So the sum total of this is 309,523, and we take a 5% interest on this outstanding balance as well. Because the customer did not pay me, so whatever is the balance in his ledger, we're going to charge interest on the cumulative balance. So 5% interest on this will be 15,476. And then finally, on 1st April, we are providing another maintenance services to him. That is the last information given. And the second service, I think if I take you back again, the inputs which are given on this is the second service, it says, is costing the company 50,000, and they've got a practice of adding 50% on the cost. So 50,000 plus a 50% margin would make it a total of 75,000. So let me also see what is the transaction price given. That is 4 lakh, that comes later. So in this case, we are going to charge him 75,000. And now we can see what is the sum total of all this, because on 1st April, he is going to pay us a total transaction price to the extent of 4 lakh. So let's see if this matches. This was 309, 523, 15, 476, and another 75. The sum total of all this is coming approximately equal to 4 lakh, just 1 rupee difference. I think this proves the calculations that yes, there is a significant financing component. You can make a separate chart, you can make a ledger account, whatever is comfortable. But I think the best way to do this is that the moment you make a ledger account, you are able to capture even the entries which you are going to record. To me, I think making a customer ledger is going to be useful to answer the journal entries required in the question. So this, I think, proves, this is, this proves, the proof is there with us that yes, financing component is significant. The proof is clear that financing component in this case is definitely significant. So we answer the first requirement of the question, where he says, tell me that what are the various components. So there is a sale of machine, that is one performance obligation. There is a provision of maintenance services, that is another performance obligation. And the financing component is significant indeed. So when the question says, what are the various components? When the question says, what are the various components? I would say there are three components. One is the sale of machine. That is one. The second is there is maintenance services provided. And number three, we can say significant financing component as well. Wow. I think that takes care of the first requirement of the question. You want me to show you the journal entries as well? Or do you think this entries are manageable through the customer ledger, or you want me to do this? Otherwise, I'm ready to go to the next question. We can do more questions if you desire so. You want me to pen down the entries, or can we go to the next one now? Okay, more questions, please. I think that makes sense, because I think once we have got the basic essence of the fact, it becomes easy. Now, another interesting question, I'm coming back. Let's take you to another question as well. This is also an examination question. And that's also interesting. Could we have access to these solved questions? Yes, this entire solutions will be, of course, what I'm doing on the board will be uploaded on the ICAI, the portal. So you'll definitely get access to that. No worries. Let's, I think, have a look at this question. It's a brilliant question indeed. Question number 12. And this is also an examination question as well. So I think let's first read the inputs which are given in the question. It says an entity has got a fixed fee contract, which is 22 lakhs to develop a product that meets certain specified performance criteria. The estimated cost to complete the contract is 20 lakhs. The entity will transfer the control of the product over 5 years, and the entity uses the cost to cost input method to measure the progress of the contract. So the company is using an input method in terms of determining the degree of completion. That is supposed to be the cost incurred till date upon the total estimated contract. Then he says there is an incentive award is available if the product meets the following criteria. It says if the weight is 951 or greater, then there is no award. The incentive fees is nil. And if it is 701 to 950, the award is 220. And if it is supposed to be 700 or less, then it is 25%. So we're given different awards, which means he's talking of the variable consideration element. It says the entity has an extensive experience that meets the specific performance criteria. Based on the experience, the entity has identified 5 engineering alternatives that will achieve a 10% incentive and 2 which will achieve a 25% incentive. In this case, the entity determined that it has got a 90% confidence level that it will achieve a 10% incentive and a 10% confidence level that it will achieve a 25% incentive. The probability of getting a 10% incentive is much more as compared to the probability of getting a 10%, 25% incentive. Based on this analysis, the entity believes that 10% is most likely when estimating the transaction price. Therefore, he said already, he's made the life very simple. He's already said that the variable consideration should be taken on the basis of most likely outcome. So he says that we're going to get a 10% bonus, 10% award that is more likely to happen. Therefore, the entity includes only a 10% in the transaction price when calculating the revenue because the entity concluded it is probable that significant reversal in the cumulative revenue will not occur when the uncertainty associated is subsequently resolved. Because the standard is very clear that if there is a variable consideration, we will be able to recognize it as revenue only if you can prove that there will be no significant reversal of the cumulative revenue which has been recognized in the past. Then he says further, I think so far he's just been hinting upon the fact that you need to take a revenue based, the variable consideration based on a 10% incentive. Then he says entity reassesses the production status quarterly to determine whether it is on track to meet the criteria for the incentive award. At the end of year 4, it becomes apparent that the contract will achieve the weight-based criteria. Therefore, the entity revises the variable consideration to include 25% incentive. Now, I think this is one thing where the examiner was trying to test us that when there is a change in the variable consideration, that would mean that there is a change in the transaction price. Now, quick question to you friends at this stage. If there is a change in the variable consideration resulting in a change in the transaction price, do we apply a cumulative catch-up adjustment as well? Just like we did in case of a modification, is that technically correct to understand that if due to a change in the variable consideration, there is going to be a change in the transaction price, would that also trigger the need for a cumulative catch-up adjustment? Absolutely yes, that's rightly said. Okay, so I think in this case, the examiner was testing us, are we aware of the concept of cumulative catch-up adjustments resulting because of change in TP? Then he says, analyze the impact of changes in the variable consideration when the cost incurred is given. So this is the cost incurred with the company. December 21, 10 marks. It says calculate the yearly revenue, calculate the operating profit and the margin percentage. For simplification purposes, calculate the revenue for the year independently based on the cost incurred during the year divided by the total cost. He is giving you a clear-cut instruction. He says, please do not consider the percentage based on the total cost incurred till date. He says, for simplicity, you are going to consider your degree of completion for each year on an independent basis. You're going to consider the cost incurred only during the year as a percentage of the total cost. And with the assumption that the total cost does not undergo a change. Because generally what happens when you go to the second year or the third year, as you progress, you tend to consider the cumulative cost incurred till date. But he's very clearly telling you, you're not supposed to do that. Okay, so I think the question seems to be looks lengthy, but trust me, it's not that lengthy indeed. It's not that complicated indeed. So let me stop sharing the screen and we're going to solve this now with you. So this is, I guess, question number 12. So let's see. the inputs in terms of question number 12. Now, the focus of the question is very clear that I want a revenue, I need an operating profit, and I need the profit as a percentage of revenue for each of these years. So how many years information is given to me? I guess 5 years. So let's organize the data. So we're going to organize the input for year 1, year 2, year 3, year 4, as well as year 5. And let's consider first of all the degree of completion. I'm putting it as DOC. Now, as per the instructions given in the question, you need to consider the degree of completion not cumulative, but each year on a separate basis. So what we're going to do, I'm just going to share the inputs back again, and let's calculate each one. First, let's take the total cost of all the years put together. It's 120 plus 370 plus 820 plus 570 plus 120. I think the total cost is 20 lakhs. So first year is 120 by 20 lakhs. I think it is coming to 6%, I guess. Then next it is 370 divided by 20 lakhs. I think it comes to 18.5% independent. Oh, sorry. Okay. I'll just keep the question in front of me. So then it is supposed to be 820 divided by 20 lakhs. It comes to 41%. And then it is 570 divided by 20 lakhs. It's 28.5%. Remember, these are not cumulative percentages. These are independent percentages which you have taken. And this again comes to 6%. Now, a very obvious question indeed, but I think I still want to ask you that question. Just take the total of this. Does it come to a total of 100? Just see, does that come to a total of 100? And if it does not, that means you've done some grave mistake. Because in this particular case, it's an independent degree of completion, not cumulative in nature. So I think you can even mention to the examiner that this is not a cumulative degree of completion, because he's very clearly instructed you that do not take the cumulative percentages. Now, we need to get the transaction price. So let me first of all consider what is the transaction price. Let me put it out here. Then based on this, we are going to consider the revenue as well. Based on that, we'll consider the revenue. So there is a fixed consideration. I think if we look at, so may you take a question from the study material given in practice question number 5 after this. I have created some tailor-made questions on this. So I think if we get time, we'll definitely do that as well. Okay, so let me, I guess, look at the data. The fixed consideration is clearly stated in the question. I think it's 22 lakhs. So I think if I just write down the fixed consideration, that is 22 lakhs. And this, of course, is going to be same for every year. But we need to also consider the variable consideration as well. And I think we are clearly given that there is a change in the variable consideration once a reassessment is done. And that change, I think, occurred which year? We had an incentive to the extent of 220. And I think that reassessment took place, I think, in the 4th year. So that change occurred in the 4th year, that's right. So my variable consideration based on the first slab is supposed to be 220, then 550. So this is 2.2 lakhs. This is 2.2 lakhs. Till 3rd year, it remains 2.2. Then 4th year, it becomes 5.5. Then it becomes 5.5. So what I've done, I've just organized what is the fixed consideration and what is the variable consideration. And now we are going to recognize a revenue based on the degree of completion. So let's consider, I can comfortably take the sum total of this into 6%, sum total of this into 18.5, and so on. So let's take 22 lakhs plus 2 lakh 20 into 6%. I think it comes to 145,200. Similarly, 22 lakhs plus 2 lakh 20 into 18.5%. That is, I think, 447,700. Then it is supposed to be 22 lakhs plus 2 lakh 20 into 41%. That's 992,200. And then it is supposed to be 22 lakhs plus 5 lakh 50 into 28.5. That's 783,750. And then it is 22 lakh plus 5 lakh 50,000 into 6%. That comes to 165. And I think now we also need to consider the cumulative catch-up adjustment. Would you like to tell me how would I calculate the cumulative catch-up adjustment for the fourth year? Give me your inputs in terms of what is the figure which is the cumulative catch-up adjustment for this year. Okay, degree of completion, what we have done, we have taken the cost incurred for each year as a percentage of the total cost. If you add up the cost of all the 5 years put together, so this is what I've written as degree of completion. DOC is the degree of completion. Okay, so tell me, how would you capture the concept of the cumulative catch-up adjustment in this particular case? Because the TP undergoes a change, and when the TP undergoes a change, you need to basically do retrospective computation and then a prospective accounting. I always tell people there are 3 kinds of accounting. One is called retrospective, which is completely retrospective in nature, computed with a retrospective effect, accounted with a retrospective effect. The second is what you call a prospective accounting. It is always accounted prospectively. But the other one is what we call the cumulative catch-up adjustments. You compute it on a retrospective basis, but we apply it on a prospective basis as if we knew that this changes occurred previously. Okay, so we need to remove until the 4th year. That's right. So can I do one thing? Just pinpoint me on this. Can I do one thing? I take the sum total of this. I'll just put the figures, vouch me carefully. I take the sum total of this and multiply it with this degree of completion. I take the sum total of this, multiply with the cumulative degree of completion minus all these revenues of the past. Is that correct? The simple way is, this is the new TP. If you knew that this is the new TP, you would have taken, multiplied with this cumulative percentages minus the cumulative revenues taken for 3rd year. Is my thought correct? So I just multiply my transaction price with the accumulated degree of completion and compare it with the revenues which have been taken till date. And that's right. Let's take the sum total. This is 18.5 plus 6 plus 41, 65.5 into 27 lakh 50. So I think if I just work this out, this is 41 plus 6 plus 18.5, 65.5. This is, I think, coming to 180, 250. And let's take the sum total of this revenue, 145,200, 447,700, 992,200. This is, I think, coming to 1585,100. So let's see the difference. That is the cumulative catch-up adjustment. So minus 1801,250. This is, I think, coming to 216,150. So trust me, the calculations of the cumulative catch-up adjustments are very simple. You just need to be doing a very simple exercise. The TP changes in the 4th year. So when the TP changes in the 4th year, you just take this new TP, multiply it with the cumulative percentage of completions in the past. You will come to know what revenue you should have taken so far. So this is the revenue which I should have taken so far, and minus the revenues which I've already captured. And when you take the reduction, you get the cumulative catch-up adjustment which is taken in the year in which the TP undergoes a change. Trust me, once you've done this calculation, the question is over. But still, we'll just complete the basic details. You can keep calculating the profitability. So we reduce the cost incurred and we're going to get the profits in this case. And after you get the profits, you can express the profit as a percentage of the revenue as well. I think the cost is already given to me. Let me just pick the figures up. So the cost incurred is to the extent of 120, 370, 120, 370, then it is 820. I'm just writing the figures, rest you can do. I thought of reversing only the variable cost. No. Then 570 and 120. And trust me, the question is done. The question is technically done. Because once you've done the calculations on the revenue, typically the cumulative catch-up adjustment, then I think there is nothing which is left over. That is the cumulative catch-up adjustment. I think this is the only crucial point which was there in this question in December 21. Other than that, I think it's just simply basic calculations indeed. Right, so that takes care of another question with us. Let's go further. Now, let's take you to another question as well. So we've done questions on the step number 1, 2, 3. Now time to do questions on step number 4. So I'm going to now take you to questions on step 4. So out of 20 super questions which I've selected, 13 questions already done. And now I'm going to take you further on the step number 4. Now there's nothing crucial to be told as far as step number 4 is concerned. But I think you know that when you apply the concept of step number 4, the basic thumb rule is that you need to basically divide your transaction price to the various performance obligations, and that is in the ratio of the standalone prices. But we also know that there are certain methods on the basis of which the standalone prices might be computed, because sometimes the observable market prices may not be available, and therefore the standard still says that you need to organize the data by considering those prices as well. Okay, so I think let's have a look at the question number 14 with you. We'll just read. It says GTM is provided. GTM is provided the following 4 independent scenarios. You're advised to respond to the queries mentioned at the end of each scenario. Support your answer with the relevant extracts of the applicable Ind AS. Now it says in scenario number 1, GTM enters into a contract with the customer to sell GTM in exchange for 1,90,000. That becomes the TP. GTM will satisfy the performance obligations for each of these products at different points in time. So you're going to basically meet the obligations at different points in time. GTM Limited regularly sells product G separately, and therefore the standalone price is observable. So as far as the first product is concerned, the standalone prices are directly observable. The standalone price of T is not directly observable because the standalone price, because the standard makes, insist on the fact that even if the standalone prices cannot be determined, you need to derive it by some method or the other. And there are various methods which are given in the standard for the same. So it says because the standalone prices are not directly observable, the company has to estimate them. That's what the standard even insists. To estimate the standalone prices, the company uses an adjusted market assessment approach for T and the expected cost plus a margin for M. So they've taken 2 different methods in terms of determining the standalone prices of T as well as M. And then it says, in making these estimates, the company maximizes the use of observable inputs. The net result is that I am given the standalone selling prices of all these 3 products separately. Now, my quick question to you. Can I say the transaction price is supposed to be 1,90,000 as is given in the question? Now, my question is pretty simple and straight indeed. Can I simply divide this 1,90,000 in the ratio of the standalone prices? Can I simply, in this particular case, divide this 1,90,000 in this particular ratio itself? And I get the answer no. Why not? Why not? In this particular case, I have estimated the standalone prices of all the products by some method or the other where we've used the maximum observable data. I think I get G is independent to observe. No, 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 friends. I think that does not make a difference. I think I need to clarify this agenda to you. Well, I think if you're thinking that I cannot divide this in the ratio of standalone price, I can of course do that. The standard only says that you need to basically use certain methods, but these methods should make use of maximum observable data. And if you made use of maximum observable data, you can definitely do that. So in the first part, since the company used techniques by using maximum observable data, I can undoubtedly divide this in the ratio of the standalone prices determined using different methods, of course. Right, I hope you got the inputs clear on that. We can definitely do that. So I think in this particular case, you can definitely divide it in this ratio itself. I think I'm not showing the calculations. That is only a matter of presentation. Let's go to the scenario number 2. Now it says GTM regularly sells products GTM individually. The standalone selling prices are given. Now it says this is the same data which is given for scenario 1. He says, in addition, the company is regularly selling T and M together for 1 lakh. They are selling T and M regularly for 1 lakh. Now we need to see what is the total standalone price of T and M. Can I say if you look at the total price of the companies put together, I think the total price in this case is again 1 lakh 10. I think your mind must be thinking now on the right track, absolutely. The company sold all the products G plus T plus M, and that was sold at a discount of 10. The company also sold T and M, and that was also sold at a discount of 10. So can I say the company is giving a same discount whether they sell all the 3 products together or they sell only 2 products together? What does this mean? Are you going to allocate the discount towards G? That is the question. In this particular case, when you're looking at the inputs, when you're looking at the input, the discount on all the 3 products line put together is 10, and even the discount on T and M is 10. Are you going to allocate the discount to the product G? Of course not. So can I say in this particular case, no discount is going to be allocated to G. So let me, I think, first concentrate on the allocation of 1 lakh 90. So can I say out of this 190, how much are you going to allocate towards G? Let me ask you. When you go to allocate towards G, we are not giving any discount portion towards G because the company does not give any discount. So how much are you going to allocate towards G? That's right, the entire standalone price of 90. So can I say the remaining 1 lakh rupee is going to be allocated towards T and M, and this will be divided in which ratio? Can I say the ratio of the standalone price, that is 44 is to 66? That's absolutely correct. So in the previous one, that is scenario number 1, we were not given any information. So we could undoubtedly assume that the company is passing on the discount to all the product lines put together. And that's right, in this case, first to G and then to the product T and M in the ratio of standalone price. Now there is more data which is given further. It says the company enters into a contract with another customer to sell GTM for 190. GTM will satisfy the performance obligation. So I think this is done. Now let's go to the scenario number 3. GTM enters into the contract to sell GTM as described in scenario 2. The contract also includes a promise to transfer another product called Hope, and the consideration is given 240 in totality. And we're also given the standalone prices of the company Hope. It says it is in a range of 40 to 65. So what is the average at which the Hope is sold? If I consider the average of this range, then what is the average price in this case? 65 plus 40 divided by 2, the averaging is coming to 52,500. Now, I think let's come back on the detail. The company is now selling 4 products together. So what is the transaction price they are charging? So if I just go back, the transaction price they are charging is 240. So can I say out of this transaction price of 240, so out of this transaction price of 2,40,000, can I say we can allocate 190 towards the product GTM, and this will be based on the scenario number 2. This is going to be based on the scenario number 2 itself. And we can say the remaining 50,000 is going to be allocated towards hope. Now the question arises, would you like to tell me, are we using a residual approach in terms of allocation of the TP? Of course, yes. What we have done in this particular case is we have allocated that out of the TP, 190 goes towards GTM. So the remaining 50 is the residual approach. Now what is important is that when you allocate the remaining 50 towards hope, it should be almost equal to the average price at which the products are sold. So can I say, is the residual approach appropriate in this particular case? Since the allocation based on the standalone prices approximates the range of prices, we can say yes, it is definitely appropriate in nature. That is scenario number 3. This is again examination question, 12 marks. I think this is pretty easy and straight based on a step number 4. So you can notice that we've done some very crucial questions on step 3 as well as in terms of step 4. Okay, now let's come to the scenario number 4. The same facts as in scenario number 3, except that the transaction price is supposed to be 220. Okay, so your face is not fully visible. Okay, I understand that, but since I'm sitting in the different setup, I'm going to change things in the next class, don't worry. But I was having a setup where I was running my board at the moment, so that was a little reason. Bear with me for the day, no worry, next time it'll get all sorted out. Okay, so next we are given the input, the same facts as in scenario 3, except that the transaction price is now 225. So now the question rises that if you consider 225 and you allocate 1,90,000 towards GTM, so what will be allocated towards the other product? Can I say 35,000 will be allocated towards hope? But do you think this is matching with the average in this particular case? Of course not. So can I say in this particular case, the residual approach is not at all appropriate in nature. So what will you tell the examiner in this case? You need to tell the examiner that a more appropriate method needs to be selected by the company. We cannot, of course, make any suggestions in terms of what method will be used, but we need to definitely tell the examiner that yes, the residual approach is not appropriate because the residue which is left over is not in parity with the average price at which we sell hope. So moral of the story, I think without doing much documentation on this part, so we can say in terms of the step number 4, I think maybe we can make a quick little mind map on this as well. Okay, let's do this. So if I were to make a little quick mind map on step 4, because if you ask me in terms of the 5-step model, I think these are the 4 crucial steps which are there in the standard. The 5th step is not very complicated because that is only deciding the timing factor for revenue recognition, whether it is going to be on a percentage or a completed contract, where you've got 3 parameters, and on that basis you decide whether you use a PCM or a CCM for each and every performance obligation. So I think if I just pen down the mind map in terms of the step number 4. So we can say in terms of step number 4, when you're looking at the allocation, what should come to your mind is the basic thumb rule. What should come to the mind is the basic thumb rule, and the basic thumb rule is that it is allocated in the ratio of standalone price. It is allocated in the ratio of the standalone selling price. And can I say this is irrespective? This is irrespective if methods are used. If methods are used to determine, this is irrespective methods are used to determine the standalone price. It does not make a difference that whether you have estimated the standalone price, but what is important is that it should be based on observable data. It should be making a maximum use in terms of observable data. If your standalone prices are determined using different methods, it's not a problem. But what is important is that it should use a maximum observable data for that particular purpose. And then finally, we can say that what we need to be cautious on is, I would say there are two things to be cautious on. One is if another package is being sold, you need to be cautious on that part. Like, for example, in the scenario number 2, you saw that the company was also selling another package deal as well. So if they're selling that kind of package deal, you need to be careful that in that particular case, if the discount on that smaller package is approximate to the discount on the larger package, there might be some product to which a discount would not be allocated. And the second caution is the use of the residual approach, where you need to see that is it appropriate or not. So we need to see that is it supposed to be appropriate or not. That is the major issues, which is appropriate or not. So is that appropriate or is that not appropriate? That is what needs to be evaluated. So this was a 12-marker question in the step number 4 as well. Right, friends. So I think that takes care of the major chunk in terms of things. Now, I think for the step number 5, I'll just take a quick recap on things. I put some more questions as well, but there are a few questions on the contract cost and all, which are pretty easy in nature. But I think I'll just like to take a quick recap on the step 5, the main crucial questions we've covered in this. Okay, so I think just take a little quick recap on the step number 5, and we can just recall that when revenue is taken on a percentage and when it is taken on a completed contract before we close this standard. Now, when you consider the concept of CCM or a percentage completion method, in this particular case, what is important is number 1, you need to identify that we need to select the PCM or the CCM method for each and every performance obligation. We need to be very crystal clear that it is not necessary that all the performance obligations are measured using the same method. We may land up using a different method for each and every performance obligation as well. Now, there are only 3 circumstances in which case you say that yes, a percentage completion would apply. If you can prove that the customer is getting a simultaneous benefit as the company performs the obligation, which is typically true in terms of all the service kind of contracts, that if you can prove that as I perform the service, the customer is getting a simultaneous benefit, a PCM could apply. The second one is that if the work is still in progress, and in those particular cases, the control of that semi-complete item, the WIP, is still with the customer, then I can do a PCM. Typically happens in the real estate industry where the building under construction and the revenue can be taken on a percentage completion. And the third factor, which is important, is the inputs, that when the things being done by the company is something which is tailor-made to the needs of a client. You're doing something which is tailor-made, specialized kind of work for the client, and at the same time you should be in a position to recover not only the cost incurred but also with a reasonable profit margin. So there are 2 sub-conditions, you can say. It's a tailor-made work which is done for the client, number 1, and number 2, you should be able to recover the cost with a reasonable profit margin. In these 3 cases, revenue can be taken on a percentage completion. Rest all the cases, of course, if these parameters fail, it becomes a completed contract method. So this is in a nutshell the concept of Ind AS 115. We made, I think, the best of the time. Typically all those typical examination questions which came for like 10, 12, 14 marks in the exam, I tried to cover all that as well. There is always a dearth, there is always time to do more things as well, but things of course have to come to an end as well. So I think this finishes a journey, friends, on the concept of Ind AS 115. In the next session on Friday, we're going to start a journey on the least standard, that is Ind AS 116. As we go further, I'm also going to try to incorporate some MCQs as well. Time gets a little limited. Otherwise, maybe what we can do towards the end of each sessions at time permitting, we could add some, a little exercise on the MCQs as well. So you get a flair of both the comprehensive, subjective and the objective questions as well. Okay, so could you please refer to some concept notes for comprehensive revisions and extra practice questions as homework? There are a few questions in the particular, the PDF which is going to be shared with you. I'll be sharing this particular solution slide as well and the PDF which I shared. So there are almost like 20 questions on that. So you're going to find some few more questions for practice. Though, of course, with a limited time, it's not possible to cover up all the questions and all. But yes, I think we'll maybe try to add some more questions to the list of those super 20 questions for extra practice as well. But, the idea was that, once we go through all these questions, you're able to at least, get the conceptual quick revisions of all the major concepts in the standard. I would say the typical steps are the step number 3 and 4, which one needs to, definitely emphasize in terms of the standard. Thank you very much indeed. That was great. So thank you, all of you. I think that's all what we have time for, friends, now. So I'm going to take leave from you now. Going to see you on Friday for the revision on Ind AS 116. Thank you very much. Thanks for joining. Bye-bye. Enjoy your day. Haji, thank you.